bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the August 6th, 2024 podcast, and I'm here with my partner, Charlie Rhuda, one of Novogradac's leading partners in our long-term housing tax credit practice. We're very excited to bring you this week's podcast. This is our latest installment in our So You Want to Be a LIHTC Developer series on the podcast. This series is designed to help developers who are new to long-term housing tax credits, to help them learn the basics about financing affordable rental housing with tax credits. For our listeners' convenience and our viewers on YouTube, we have posted a playlist of episodes in this series, and it's available on our YouTube channel. I'll post a link to the playlist through my account on X, formerly Twitter, at Novogradac. I'll also include the link in today's show notes and on LinkedIn. You can also just go directly to our YouTube channel. It's youtube.com/Novogradac CPAs. And while this series is aimed at covering long-term housing tax credit basics, it's also designed to be useful for more experienced developers. Part as a concise refresher reminder for those already working in affordable rental housing, as well as providing a handful of tips that an experienced developer might not be aware of, or at least may not have remembered. Now, our topic for today is an extremely relevant issue for anyone working in affordable rental housing, whether you're new to the long-term housing tax credit or a seasoned veteran. Today's topic is how to access 4% long-term housing tax credits and tax-exempt bonds in a ever more competitive market. We'll also discuss some of the ways to enhance the aggregate economic benefits of such financing. But first, let me give some background. There are two ways to access federal long-term housing tax credits. Either one, what is commonly referred to as 9% or allocated credits, or two, what is commonly referred to as 4% or private activity bond credits. Now, I won't detail the differences between the two approaches here. We did have a prior podcast dedicated to explaining those differences. I'll include a link to that episode in today's show notes in case you're interested. Today, we're talking exclusively about the 4% or private activity bond access long-term housing tax credits. As the name implies, the 4% credit is paired with tax-exempt private activity bonds to finance affordable rental housing. I'll also note private activity bonds is also often referred by the acronym PABs. I guess I should say initialism PABs. Let me share a bit of history on how we got here. Way back in 1968, Congress authorized private entities to use tax-exempt private activity bonds to finance projects that provide public benefits, with the concept being that tax-exempt private activity bonds could be issued at a lower interest rate, such that a given activity could generate more debt financing for a given amount of debt payments. Now, there were different categories of projects that qualified for this type of bond financing. Among them, or else we wouldn't be having this podcast, is the production or preservation of affordable rental housing. Then in 1986, Congress put a cap on the amount of certain types of private activity bonds that a given state could issue. As such, today, to access private activity bond financing, an affordable housing developer generally takes one of two routes, and it'll vary across the various states, as well as possessions. The first option, the first approach, is working with government entities to apply to a statewide agency for a portion of the volume cap on behalf of a given affordable housing development. It's very common in California by applying to CIDLIT, the California Debt Limit Advisory Commission, or Allocation Committee, I should say. California Debt Limit Allocation Committee. The second approach, and this is true in a large number of states, the developer applies for a private activity bond-backed loan from a government issuing entity that already has a portion of the state's or all of the state's private activity bond allocation issuance authority. Now, affordable multifamily rental housing properties that are financed by private activity bonds can generally receive 4% long-term housing tax credits if they meet certain conditions. One of these conditions is that the productivity bonds finance at least 50% of the aggregate basis of the development. There have been efforts to lower that 50% test, but we haven't been successful so far through federal legislation. Now, using 4% credits with productivity bonds has been a source of financing for the construction, acquisition, and rehabilitation of affordable housing since the long-delayed tax credit was created back in 1986. I will note the 50% test originally was 70%, and you weren't getting a lot of housing finance with a 70% finance by test. And then it was changed in a subsequent amendment to Section 42 in the late 80s, such that we could see a lot more usage of productivity bonds with tax credits. In the past several years, we've seen unprecedented growth in the use of productivity bonds for affordable multifamily rental housing. I say that, but let me give you some numbers. The amount used a productivity bond cap for affordable rental housing more than tripled between the years 2015 through 2021, going from $6.6 billion to more than $20 billion. The market has since held its own or even grown due to various factors. We don't know exactly because the data isn't readily available. Now, the enactment of a 4% tax credit minimum rate really spurred on more tax credit financed housing with productivity bonds. And then the pent-up demand from the COVID pandemic has also been a bit of an initiator. Other factors that have led to an increase in the demand for bond financing is that given the broad need for affordable rental housing across the country, many states have created state long-term tax credits to pair with productivity bonds to help fill financing gaps. They've also created soft funding programs. There's also been an influx of new developers in the 4% tax credit space that has helped push demand. We've seen both market rate developers and developers previously only with 9% credits enter the 4% credit arena. You can find a more detailed discussion of this in my Washington Wire column in the Novogradac Journal of Tax Credits. It's in the August issue. I'd encourage you to read it. And if you have thoughts or comments on it, please tweet them to me and at Novogradac. The bottom line overall is there is competition for productivity bond financing in the majority of states in the nation. So the question you might have is, how can you as a developer compete in this marketplace? And that's the focus of today's podcast. And we're going to tackle this topic in 4 major parts. First, we'll start off with some additional background on how bonds work to finance affordable rural housing, productivity bonds or PABs, that is. Second, we'll talk about the current state of the productivity bond marketplace. Third, we're going to flag some of the challenges of accessing productivity bond financing. And then fourth, we'll conclude with action items that you can take to help be more competitive for 4% tax and bond financing allocations. That is a lot to cover. So if you're ready, let's get started. So Charlie, thanks for putting up with that long introduction. Now, you were on the podcast last year. We talked about how affordable housing developers need to meet the 50% finance by test, as well as the 95.5 test for productivity bonds. Great to have you on the show again. Talk about what's going on with the productivity bond market. So thanks for coming back.
Well, it's great to be back, and I can't believe that it's been a year already. Time certainly does fly.
Yes, indeed. Now, before we dive into today's discussion, let's start with a brief introduction of you to our audience, for those that maybe didn't listen to the podcast or from a year ago. Share with them some of the areas of your expertise and some of the services you provide, particularly with respect to the local living tax credit.
Sure. Well, hopefully some of the people did also see me on our webinar in July of this year, do a much more full discussion of private activity bonds and 4% tax credits. But anyway, my name is Charlie Rhuda. I'm a partner here in the Boston office for Novogradac. In September this year, I will have 20 years with the firm, which is a great milestone. And I've been working on local housing tax credit development this whole time, mostly these days on private activity bonds. So, on the local housing tax credit side, I sort of look at, we used to call it cradle to grave, but I don't call it cradle to grave anymore. I call it cradle to rebirth. Because the end of the 15-year period, something is happening and the property is being reborn. Property's not going away. It's not going anywhere. It's going to have a new use or a new life. So, starting out, we're going to talk today with the bond program, helping structure, helping acquire resources and all of those things that you need before you can close with an investor. Through with the construction period, traditional audit tax services, and then on the back end, either a restructuring, a resyndication, a sale, or some other transaction that will again help the property with its new rebirth. Primarily, I've been working with tax-exempt bonds more so than the 9% credit, which we're going to talk a little bit about. And really, that sort of came to effect around 2008, 2009 period when we had the financial crisis. I happened to be doing a lot of work in New York, and New York was one place where they were still able to do bond deals, where in a lot of the rest of the country, they struggled because of the financial crisis. And ever since then, people realized that hey, we were pretty good at it, and came back, and now it's most of my practice. So it's been really, really great. Been interesting to see. Initially this was mostly for preservation. At least that's what I mostly saw it for. And now I'm seeing in a lot of places bonds being used for new construction, partially helped by the fixed 4% floor, which provided more equity for tax credit bond, and partially because more and more people are entering the program and using the program and finding out that it can and does work. I will add a funny anecdote. Many, many years ago, I had a client of mine on a panel on bonds, and he said that the 9% low-income housing tax credit program was the gateway drug into the 4% tax because it's a little bit more complicated and there's a few more things going on. So I usually like to throw that one out there.
No, that's great. And I love your cradle to rebirth. I'm going to call that a Charlieism.
Yeah, there you go. Well, that's good because we have a lot of Mike Novogradacisms around.
And I will post a link to your webinar on bond financing show notes, so listeners and viewers can click on that if they're interested in learning more about that. So let's jump into our first segment today. First of 4, the bond financing basics. I gave a bit of a high-level overview in today's discussion in my intro about using 4% tax credits, pairing them with private activity bonds. Beyond that, there are some key concepts that are probably worth, or certainly I think are worth discussing with our audience. And there's 3 key concepts that come to mind. The first concept is the 4% local tax credit being viewed as a quote, as of right tax credit. So if you could explain to our audience what it means to be an as of right tax credit.
Yeah, sure. So sort of as of right, meaning that you're not applying for tax credits, right? You're applying for buying, you're applying for a loan, right? Depending upon the way that your agency is structured. And so if you get that financing and you meet certain tests, you automatically get tax credits that go along with your development. And those tax credits are calculated based upon the cost of your development. So on day one, you have your pro forma, but you don't necessarily know how much you're going to be able to get in tax credits, which contrasts with a 9% transaction where you get an allocation of credits and I have $1 million worth of credits, assuming that I spend everything on an eligible basis that I originally expected to. So here you're applying for financing and then you're getting the credits as of right for complying with all the program requirements.
Thank you for that. In some ways, the 9% have volume caps associated with them. And the 4% also, the private activity bonds have volume caps associated with them. So both of them are coming out of a volume cap. It's just one is indirectly through the bonds. And as they're commonly referred to as of right, but they're not as of right like, ITC, renewable energy ITCs are, in the sense that you satisfy all the things you're supposed to satisfy, and you as a taxpayer have a right to claim them. They're as of right, but really they're not quite so much as of right, in the sense that you do have to go to the tax credit allocation committee and get approvals to claim credits, and they have to do a feasibility review and the rest. So you do have to go and get the approval of the state agency to claim those tax credits. And developers need to be mindful of applying. And usually they'll apply, as you know, you'll apply before you start construction, where the state agency says, if you do everything you said you're going to do and all the rest, these are the amount of credits you'd be entitled to. And then if you spend more cost on all the rest, you can often go back and get more credits. But there is that initial process where you get sort of pre-approved for a certain credits. I don't know if you want to add anything more to that. It's important for developers to realize they don't just march forward once they have the productivity bonds without interacting with the state on the tax credits.
Yeah, no, that's a really good point. And even more to that, in a lot of states, you might need to go to the group that administers the 9% program, because in the end of the day, they may be the one approving your cost certification submission. So at the end of development, you have to submit a certification to the amount of cost that you had in order to get the amount of credits, one. And two, you may also need to go in to make sure that the project that you're doing conforms to the qualified allocation plan of the state.
Yeah.
You're not going to find an issuer and do something that isn't, one of the high priorities of the state. So yeah. So, in the ITC world, you can go out, you can do certain things, and then you just apply and you get the credits. But here, you're still sort of in a program. And so the credits are as of right with financing, but you still have to abide by a whole bunch of the other metrics of the program, including, getting with the agency early and making sure that what you're doing is in accordance with, what their initiatives and their goals are.
Yeah. Thank you for pointing out it's not just you need the credit. It's also, there's a series of other requirements that can be in place that you need to satisfy.
Right.
I'll thank for that overview. I mentioned three areas in these first part, the basics area. Second key concept that I mentioned in the introduction is satisfying the 50% test. We went into it in detail in your prior podcast, so don't go and do it in length. But if you give a quick glimpse into what is meant by the 50% finance by test.
Yep. So yeah. So again, had that, like the webinar, we spent a great deal of time on it, but just for this, so it's a fraction. The numerator of the fraction is the amount of volume cap bonds that you receive, and the denominator is your aggregate basis, right? An aggregate basis is more than just your eligible basis, right? It's your depreciable basis plus land. And so to the extent that you have greater than 50%, when you do that fraction, you pass the 50% test, and therefore 100% of your eligible basis costs are eligible for asset right 4% tax credits. We just threw out a whole bunch of terms there, right in a row. So that's a test, and it's very important. It's not necessarily a cliff test, because if you come in at 49%, then it's 49% of your eligible costs are eligible, but you've just lost 51% of your equity. So it probably is a cliff test, but it's not.
Right.
That would
Well,
be
no, it's like you don't fall off a cliff to the bottom. You fall off the cliff, you go about halfway.
Yeah. So a long way to go to recover the remainder of that. And then I'll just mention, three more things quickly. One, we do this test at least twice. Once when you're applying for credits and bonds, and once when you're complete, right? Because you want to make sure that you're going to pass before you get started. Once to start on something that's going to fail before you even get started, you wouldn't want to do that. And then to make sure at the end, and a lot of times our clients will ask us to monitor in the middle. We'll talk more about that later. And then just the other two things is it needs to be satisfied in the first year of the credit period for buildings you're placing in service. And then you really need to think about, if you've got multi-year, multi-building placed in service, about how you're going to manage that process.
And I would just say that it sounds simple to say, and as you know firsthand, it is very involved when you start thinking about kind of the timing of when you measure it, when you think about how do you define how many bonds you have, what do you have interest being earned on bonds, and then what costs get counted or don't get counted. So it's definitely something that, developers have to be super mindful of throughout the development phase, through placement and service, and into the first of the credit period. But let's move on to the third key concept. And here I wanted to have you share something in your and explain a bit to the audience and viewers about the concept of volume cap for bonds and the concept of recycled bonds and how volume cap and the concept of recycled bonds play into private activity bond financing of tax credit developments.
Yep. So the volume cap bonds are allocated on a per capita basis, which I believe right now is $120 per. And so I have an example here from the webinar that I just did. In 2023, Illinois had a population of about 12.5 million people. And so they qualified for volume cap of $1.5 billion. Now it's also important to note, and we mentioned this already, that that's the volume cap for all uses of private activity bonds in a given state, and housing is a subset of that. But I think we're going to talk a little bit more about that later. So I'll just talk briefly about the recycled bonds. So the recycling is interesting because in many cases in bond transactions, right, you get a certain amount of bonds that you need in order to be able to pass the 50% test. But then when you get to completion and your tax credit equity comes in, some of the bonds are paid down and some of the bonds remain in the form of a permanent first mortgage. And so to the extent that a portion of the bonds have been paid down, these are sometimes referred to as burnt cap because they've only been outstanding during the construction period, which, anywhere from 18 to 24 months, depending upon the type of development that you're doing. And so what the recycling does is it allows the agencies, and we're going to talk later about some of the rules around this, but it basically allows them to reuse those bonds without taking away from their volume cap, except, and this is a very important except, you don't get to take LIHTC credits on them the second time. And so I think one of the later questions, Mike, I think we're going to, I'll have an opportunity to go through some of the restrictive things about the recycling bonds, but it's a great tool for states that are oversubscribed to be able to put additional tax-exempt bond and generally, financing that has favorable interest rates and such back into another transaction as an additional source. So, there's a lot of good uses there.
I think of it also as a bit of leveling in the sense that there are, some developments that only can handle this much, a lower amount of private activity bond as longer term permanent financing. There are others that could handle more.
Right.
But since you have this 50% finance by test, you want to use a certain amount of allocation and not give too much to any one project any more than it really needs. So you can
Right.
financing more developments or bringing 4% credits to more projects. But there's a development that really needs 60% private bond financing, and there's one that really only needs 40%. They could take that amount once they finance 50%, they pay it down to 40%. That extra 10% can go to the other project. So it's a way of keeping that resource available,
Right.
in a way that you have more overall real housing developments being financed with the same amount of buying cap.
Right. That's right. Yeah.
So let's go to the second broad area. And if you could speak a bit about the bond marketplace and what the current state of the bond market is for 4% tax credit developments.
So it's very, very active, and it's become very, very innovative, especially as more people come in. So, again, as I stated earlier, transactions using tax-exempt bonds are most of my practice area. I don't see as many 9% deals. I see a lot of bond deals in a lot of places. And, as I'm seeing the maturation of the market a bit, and I'm also seeing that, a lot of mixed income and mixed use developments because of the constraints and the desire and the need for the agencies to spread their resources, as wide as they can in order to generate the most amount of affordable housing. I'm seeing a lot of conduiting where portions of projects that are not going to be eligible for low-income housing tax credits because they're commercial, because they're going to be market rate or workforce housing or some other, something other than, a traditional 6% AMI, LIHTC, so they'll separate those out and finance those sort of separately. And so that's a way to make the tax-exempt bonds more flexible for more different types of developments that they're trying to do. And I'm seeing them used a lot more for new construction. I think I said earlier, used to see them a lot for rehabilitation, but I'm also seeing them a lot now being used for new construction. One of the other things is there's been a lot of interesting financial structures that are available with the low-income housing bonds. I'll mention one that's been very popular the last few years called the cashback collateralized structure. And it allows for the bonds to be issued and then a second loan to be issued to cash collateralize those bonds. And because I'm not going to get too deep into this, but because of the inverted yield curve in our interest rate environment, it's actually possible to reinvest those proceeds at a rate that's a little bit higher than the rate on the bonds themselves. And it generates additional proceeds that can then be used in the development to help pay for costs, which we all know have been going up. So it's a very interesting and innovative time in the tax-exempt bond markets.
No, thank you for that. And I appreciate your reference to condominiumizing
Yeah,
a private equity bond finance project, which also happens with 9% credits as well. And
right.
it struck a chord with me because last week when I was testifying in front of the Senate Finance Committee on the role of tax incentives in local community development, ranking member Braybo's first question to me was about using new market tax credits to provide services for low-income tax credit developments and how, there's some complexities there, which is in part driven by the need to use a condo type structure to bring new market tax credits to help finance services for tax credit properties. But maybe talk anything else you wanted to say about the bond market, maybe on a prospective basis. I mean, it's said that it's difficult to make predictions, particularly with respect to the future. But if you have any quick observations for listeners before we get on to our third topic.
I just think that if we wind up in an interest rate environment where interest rates start to go down, that's going to make bonds more attractive, right? It's going to make any financing more attractive. And then you made reference earlier to the 50% test maybe being lowered to a lower amount, which would allow for, again, the bonds to finance more transactions. So I think if I was good at predicting interest rates, Mike, I might have a different job.
Yeah, yeah, definitely. As interest rates were to come down, more productivity bond finance developments would be financially feasible with less soft gap sort of financing.
Right.
The bill that was passed the House overwhelmingly was voted down in the Senate, and it would have lowered the 50% to 30%. Or was it Credit Proven Act would go from 50 to 25%. We'll see if there's not another vehicle that could get that enacted this year. We're hopeful that it is. So let's turn to our third segment of the podcast. We've been talking around the concept of it being challenging to access tax-exempt bonds and the many challenges that we could sort of discuss. But in preparation for the podcast, we sort of identified 6 common challenges that developers face accessing tax-exempt bond financing to develop affordable rental housing. And let's start with the first one, which is the one that's probably most obvious to a listener or viewer, and that is the constraint on the volume cap, the constraint at the state level in terms of how many bonds they could issue. So if you could share a bit about that and how the overall private equity bond volume cap reveals itself as a constraint at a state or possession level.
Right. So I think one of the things that gets talked about a lot is a reminder that the private activity bonds are not just for affordable rental housing. I think there's 15 different potential uses for the volume cap. The one that gets talked about most in our housing circles is about single family programs. There are many states that have very active single family programs where they use a portion of their volume cap to help finance mortgages for first time home buyers, down payment assistance, and some other programs. And so, I gave the example earlier of Illinois in 2023 having a pool of about 1.5 billion, right? That's not all for affordable multifamily rental housing. So there's certainly some state level constraints about how much you want to do. The production of housing, whether it's affordable or at market rate, is important in a lot of states. There are a lot of places that are underhoused, and so there's a lot of states that are looking very strongly and saying, "Hey, we need to do more with home ownership." which is great. It's another great use, but it competes with our multifamily use. And then I would just talk about, sort of on the scarcity side, right? We have a slide that we work on with our friends at Tiber Hudson. And so as of May 2024, there was 32 states that were either oversubscribed or at parity, meaning that the demand for private activity bonds was at least as much as their volume cap allocation or greater. And then there were 19 states that were undersubscribed. But again, it's 32 states now where, everyone used to talk about on the 9% program, how competitive getting 9% credits was. And that bonds were great because you could just go in and get them. And states didn't even have they didn't have a schedule where they would have rounds where you could only apply twice a year. You could apply sort of on an ad hoc basis. And that's changed greatly now as the program has gained strength and as more and more people are accessing it.
Thank you for that. When you mentioned the breakout between those states that are oversubscribed or at parity versus those that aren't, it reminded me of Barack Obama one time made reference to 57 states. He meant states and possessions, of course.
Right, yes.
Barack Obama knew there were 50 states. And when you said 32 states that are oversubscribed or at parity and 19 states that are undersubscribed, well, wait a second.
Yeah.
Obviously District of Columbia was the 51st state. And it's not the 51st state.
You got me on that. And it's one of the ones that's oversubscribed. So it's in the 32.
But and then I would just also note to our listeners that when we talk about oversubscribed or at parity, it's either oversubscribed at parity based upon the volume cap that the state has in general, or the portion of it that is allocated to residential housing. Some states allocate all or a large portion to rental housing. Other states allocate a much smaller amount to rental housing and end up being oversubscribed. So let's turn to issue number 2 of the 6, the challenge of underwriting bond transactions. Maybe share, one or two common pitfalls or challenges and using private activity bonds that relate to underwriting the transaction.
Yeah, I really think the biggest difficulty with underwriting the transactions comes down to the 50% test and the scarcity issue. Because what's happening is, in order to maximize the amount of units that they can finance, the states are sort of underwriting you upfront at 55% on the 50% test. So what we help our clients with often is they come up with their development pro forma. We help them to calculate what they expect their aggregate basis is going to be. And then they use that to go back to the state and say, this is how much we need in volume cap bonds in order to be able to make this deal feasible. And what the states do is they limit them to 55%. So when you put the needed bonds in the numerator and your aggregate base in the bottom, it starts at 55%. The part of the problem with that is that doesn't leave a lot of room for cost overruns. We've been in an environment since COVID happened where costs have gone up greatly for a whole host of things. And so it's very difficult. In new construction, right, prices rise. So that's hard. That's unpredictable. In rehab, sometimes once you get inside the walls, you find out things that you didn't know. And so, the opportunity for cost overruns in a rehab are magnified by the fact that you don't always know what's going to happen as you start, doing some of your demolition and doing some of your other procedures. So that can be one of the greatest challenges. It doesn't leave a lot of room for error. And so that's really the first one. And then on the second one, it's timing, right? Because you have states oftentimes have committees that meet and they have boards and they meet periodically, right? And so you need to get your transaction approved by the board. You need to be able to get all your financing lined up and all your approvals and all of those things. And so, with a more traditional transaction, you're working directly with the bank, and the banks, close loans all the time. And a lot of the states, they have a closing season where everybody gets closed around the same time. And if you're not ready, you get booted to the next season, which could be the next calendar year, which is, suboptimal to say the least for everybody. And so, so between the two things, between the constraint of the 50% test and the timing of all that, I'd say those are really the two biggest challenges.
Well, actually, your point about the seasons is a good segue to our third issue. But before I mention that, let me just note that this whole question about failing the 50% test, since you get a more narrower amount, as much cushion for cost overruns and the rest. There's definitely, as you know, techniques to try to mitigate that through adjusting other costs like developer fees and the rest. And there are situations where developers have went back and got additional bond allocation, but that's certainly not something you can rely on. But that is something that there's a lot of ongoing monitoring, which you mentioned earlier in terms of how often you want to be monitoring it. Let's go to number 3.
Sure.
That relates to issuers and allocate agency rules. So you hinted at this one, or you started us down this path by mentioning that one is dealing with the seasons that
Right.
allocating agencies have. Where's the other issues that you would recommend developers be aware of in advance dealing with agencies and issuers and allocating agencies?
Yep. And this one falls under in any state that you're working in, you need to know your agency, or you need to know that the agencies, because in a number of states, there are more than one agency that you can go in and apply for bonds. Mike, you made the reference earlier about California having more than one methodology for doing that. I'll give an example. In Massachusetts, Mass Housing and Mass Development both are allowed to issue bonds for multifamily. So you may go to one of those agencies over the other. Other states have different rules. In some states, you can go to an industrial development agency, which is separate and apart from what I would refer to as the housing folks, so that the housing finance agency. So it's really important to know how the agencies are structured and how the financing works in the state that you're working with. And then, I'll throw in one other thing here. I'll call this agency capacity. During the pandemic, that housing agencies, like a lot of other parts of the economy, experienced a lot of turnover and a lot of retirements. And so there are a lot of agencies that are now that the bonds have become more active, the bond program has become more active, they actually have more work to do. And in a lot of cases, you have staffing capacities internally, which makes it a little bit more difficult for them to underwrite everything. And that gets back to the timing that I mentioned earlier. If it can't get through underwriting, it may not be ready for when the board meets. And if it's not ready for when the board meets, you may have to wait 2 or 4 or 6 more months for another board meeting. So, again, these are things to understand and be aware of when you're trying to access this type of financing.
And I'd also follow up that by encouraging, developers and others to be involved in the comment periods and the rest with the various state agencies on the use of bonds, the allocation, the various approaches. Is, the states, as a general rule, do have comment periods and the rest to try to best satisfy the needs of the affordable housing tenants in their area, and looking to developers and others to comment on the rules that are helping maximize and best use a limited resource. So if something isn't, if there's an impediment in a given year, I'd encourage getting involved in the policymaking aspect of it. Let's move now to number 4. Initiative number 4 comes down to what might be a surprise to some developers who are going from the 9% to the 4%. And that's the difference in the portion of a project cost that can be funded by the tax credit equity generated from a 9% credit allocation versus a 4% private equity bond credit allocation. And when I say the portion of a project's cost that can be funded, what I really mean is the amount of tax credit equity that you can generate as a percentage of total project cost when you're working on a 9% allocation versus the portion of a project's total project cost that can be funded by the amount of tax credit equity you're likely able to generate from a 4% private equity bond credit allocation. If you could, share the kind of the rough ranges of the two that highlights the difference.
Sure. So if we talk about this in our LIHTC 101 sessions that we do, the bonds, the 4% tax-exempt bond program can also be referred to as a 30% present value credit, with the 9% being the 70% present value credit, meaning that you're financing about 30% of your costs using bonds, right? Well, let me say that differently. The amount of tax credits that you can generate using the bonds is going to help you to fund about 30% of the present value of your development. On the 9% side, it's closer to 70%. And so what that means is the gap between 30% and 70% and 100%, right, which is all the costs that you need to be funded, is going to be a lot greater on the bond side. Now, there are some additional factors to consider. If you're located in a qualified census tract or difficult to develop area, you can get up to a 30% boost in the amount of eligible basis that you're allowed to use in your tax credit calculation. So again, if you've got a 70% present value and you're adding 30% on top of that, that's going to get you much closer to full funding of your transaction. Whereas maybe on the bond side, a 30% boost on 30% is not going to get you as far. It's going to be helpful, don't get me wrong, but it's not going to get as far. And so, on the bond side, you're often looking for additional subsidy or additional resources to be able to help fill some of those gaps. I will note on the 9% side, because the 9% credits are so competitive, oftentimes there's substantial excess basis involved in those. So, I say 70%, it could actually be less than that, depending upon how competitive that is and what the state's qualified allocation plan says about income targeting or other initiatives that they have that they would like to see. So, really what it comes down to at the end of the day is you're going to have less equity in a bond transaction than you are in a comparable 9% transaction.
Yeah, thank you for that. To unpack the 30% present value, 70% present value, I'm not sure how actionable my unpacking is going to be, but I share it nonetheless. If you read the statute, there's a 30% present value credit and a 70% present value credit. And in the first year, 1987, the 30% present value credit had was 4%, and the 9%, had the 9%. But then after that first year, the IRS would do calculations to determine what that 30% present value was. And that led to fluctuating credit percentages in the 4% and the 9%. And you heard Charlie earlier reference the 4% floor. Yeah. And now the 4% is the floor in that 30% present value credit can never be less than 4%. The 9% can never be less than 9%, which basically just means that if interest rates rose dramatically, the 4% credit could actually be higher and the 9% credit could be higher. But as a practical matter, they serve as almost like a fixed rate of 4 and 9, unless there's rampant inflation and high sort of interest rates. So you have this in that, so it's basically a 4% and 9% credit, but that's only on eligible costs. So there's ineligible costs that can't be financed by tax credits sort of directly. But there is this notable difference in terms of the tax credit equity generated from bond transactions, which leads to a need for gap financing. Feasible at 9, you turn to 4s. In most cases, you're going to need some sort of gap financing. But let's turn now to issue number 5. And you touched upon this earlier in terms of dealing with allocating agencies and timing. Maybe expand a bit about the timing considerations for bond transactions.
Yeah. So, I talked about this a little bit about, the board. Most states operate in a situation where they have a board or committee or some body that allocates the volume cap. And so I talked a little bit about timing, about making sure that you get on that and get in the right closing season. There's other timing considerations though, as well. One of the technical aspects of the tax-exempt private activity tax-exempt bonds is there's a 60-day rule for preliminary expenditures. And so any cost that you've incurred that greater than 60 days before your inducement resolution may not be reimbursable or financed by the bonds. This was actually a big deal recently on a transaction I was working on where they acquired the property prior to getting their inducement resolution on the bonds, because if that had gone greater than 60 days, then the acquisition of the property would not have been eligible to be financed by the tax-exempt bonds. So you do have that. The other thing that I would note is bonds generally have a mandatory redemption date. And so if you have significant delays, and we saw this during the COVID pandemic, I don't know that we're going to see this as much, although I was talking to somebody who had a stop work order come onto their site, is that if the bonds are going to be mandatorily redeemed before the building is complete, you may have an issue with whether or not you satisfied the 50% test and been able to have the bonds outstanding in the first year of the credit period. So I think, these are, a little bit more technical areas than we've been discussing so far, but they're important. And then on the recycling, there's a timing on the recycling. If I can just talk maybe about the recycled bonds. So the recycled bonds work great, but you can only do that for bonds that are redeemed within 4 years of their issuance date. Right? So you're not going to be able to recycle bonds that have been outstanding for a long time. So this is generally the bonds that are used during the construction period. You've got 6 months when they're redeemed to put them into the next deal. So you can think about, like, as you're closing your deals, right? 6 months isn't a lot of time for there to be slippage at the in the closing table with all the other things that have been going on. And then lastly, the maturity for the recycled bonds can't be greater than 34 years from the original date of issuance. So you've got, and I think out of all those things, the biggest one is the 6 month, right? And I think that's a big challenge for the states, is being able to get to the point where somebody's going to pay down their bonds and then only have 6 months to redeploy them into the next transaction that they need them for. So I think I think those are some of the big timing issues associated with using the bonds.
No, that's a great overview and emphasize the importance of a very experienced uh,
Yes.
bond attorney along with experienced tax attorney, which is a good segue to our sixth topic that we want to talk about, and that's coordination of the tax and bond issuance with the locally tax credit syndication. So at some level, they're different. There's the bond issuance and the rest, and those rules, and there's a locally tax credit syndication and the rules around that. And as with most things in the tax credit space, you have to use the least common denominator. You have to do your activities have to satisfy both the bond issuance rules and the tax credit rules themselves. So maybe talk a bit about the interaction of the two processes.
Yep. So you're almost on two separate tracks that are going to converge at some point. And so, yeah, so you have your tax credit syndication where you've got your eligible basis, your estimated eligible basis. You go out and you're talking to syndicators, right? You're talking to tax credit investors who are going to come in and invest equity in your transaction in return for the tax credit. So you've sort of got that track going on, which is exactly what you have in the NARC, right? You go out and you negotiate your syndicator. And then you've got the second track where you're working generally with the agency, right? Again, depending upon the state, it could be the lenders or so forth, in order to get your bond financing lined up. So to get your engagement resolution, to get something that's known as a 42M letter, which is basically a review of feasibility for the transaction on a going forward basis. You may need to get underwritten by the state, by the state 9% allocator, because they may be the ones doing your cost certification, right? And so they may be also looking to make sure that you're in accordance with the qualified allocation plan and all those things. So you get this whole secondary track going on. And then the idea is that you want them to converge at the same time, so that your bond closing and your equity closing occur at the same time in order to be able to, get all of the funds in that you're going to need in order to be able to begin construction and get going on your transaction. And they almost always close at the same time. I've seen a few that have closed on different days, usually not very far apart, but there's a lot of coordination involved in getting both of those two tracks together, because you've got bondholders on one side and an agency who have very different concerns, and your tax credit investor and developer, although there's an alignment, they have different concerns and different needs.
So thank you for that overview of the 6 tips on sort of the challenges of accessing tax and bonds. And let's move to the 4th and the principal focus of the podcast, and that's how to compete for tax and bonds. We've talked about a number of different areas, but now let's talk about best ways to compete for tax and bond financing. What are some tips that you would share with the audience to better compete for the ability to use such financing?
The first one is sort of a 2-part tip. It's do your homework and assemble an experienced team. I think as you just mentioned, and as you probably heard throughout this conversation, there's a lot of complex rules and there's a lot of regulations, and there's, quite frankly, there's a lot going on, right? So, a team of tax attorneys, of bond counsel, of professional service accounting firm to help you through all these things, right? In addition to what you would sort of have as your normal team, which would be your architect, your engineers, your construction contractor, if you don't already have a construction contractor. So it's really important to assemble the team, and then doing your homework gets back to the point that I made before about knowing and understanding what's going on at your agency and understanding the qualified allocation plan and the initiatives, and to make sure what you're doing is in alignment with what, with the housing program that the state has. And so I think that's probably, the first big tip.
No, I can't echo enough the importance of having a team that's very experienced with tax credits, with tax and bonds, uh, and for rental housing more generally. And the only thing I would add to that, which I know you would agree, is that you want them to be experienced in the state that you're working in.
Yes, very much so.
That's not necessarily the case, with other tax credits, but what not really tax credits that need to be experienced in the state that you're working in. So thank you for that tip. Please share a second tip.
So the second tip, and this is a little more broader, is obtaining the necessary market studies, appraisal, due diligence items, rent studies, and all those things. There are a lot of parties in a bond transaction. I'm on deal calls that are sometimes 30, 40, and 50 people, and they all have their things that they're concerned about. And so, I touched on it again earlier, that you've sort of got a dual track with your tax credit syndication and your bond closing on the other side. And so there's a lot of documents that a lot of people are going to need. There's a lot of underwriting going on from folks who maybe don't understand. So maybe on the tax credit syndication side, they don't understand the concerns of bond counsel on certain things. And then I know when we talk to bond counsel, they know all about bonds and bond programs, but they don't necessarily understand multifamily rental real estate as well. And so there's a lot to go on there. So there's a lot of asks, a lot of requests. And so you want to make sure that you get everything together and to all the right parties and get all of your approvals, as smoothly and seamlessly as you can.
And I can't help but plug our valuation group, our market study group, our appraisal group in this area. Just as I was folks suggesting, you really want to be sure that the attorneys and accountants that you're working with have experience in your given state. And oftentimes there'll be one accountant and more than one attorney, because you have the different specialties on the legal side, but the accounting side, generally not so much. Usually one accountant can do all the various accounting needs that you have. When you're looking at the market studies, appraisals, things of that nature, an experienced tax credit, productivity bond, market study / valuation analyst, and one that's experienced in the state that you're doing work, because states can have very, unique requirements around market studies on the bond side and the tax credit side. And you would like to get all of that and also have all of that be consistent with what a syndicator would want to see as well, your equity investor. And if there's other soft financing agencies involved as well, there could be other needs. So you want to have, a market analyst / appraiser that can satisfy and check out as many boxes as possible. And that in some ways is a bit of a glimpse into Charlie's third tip. Charlie?
So the third tip is to start looking early for gap fillers, right? So we talked a little bit about the 30% present value, 70% present value, right? You're probably going to need some additional subsidy on to help finance your bond transaction. So state credits is one that's very, very hot right now. A lot of states are adding state low-income housing credits to the roster programs that they have to help fund affordable housing. But there are other subsidies as well. So there's sort of the more traditional home bonds and block grants and other subsidies that can come from HUD through the state, through the county, through the city, or through nonprofits. We'll have access to that. And then there's historic credits. Some multifamily properties are either historic, architecturally significant historic, or historic as in history happened there, and they may be eligible for federal and even state historic credits. And then with the Inflation Reduction Act, we've gotten, a lot better ability to use, renewable energy investment tax credits, solar, geothermal. And then you have other programs in states, brownfields. There's credits available in some states for building, transportation hubs, right? And so, reducing the needs for traffic and taking advantage of public transportation. So this all cycles back to, and I've said this more and more again, to know the state that you're working in, to understand the programs and understand all the initiatives that they have available because there's a lot of resources out there. It's just a matter of going and finding the ones that are gonna work best for you, and that are gonna work best for the development that you're working on.
And I'll use this as an opportunity to plug using Novogradac as your CPA, along with experienced tax credit and bond attorneys with the long-term tax credit. Because, obviously we at Novogradac see lots of different transactions. As you're looking at gaps in transactions, the rest, reach out to your professionals. And do they have any suggestions as additional areas to be looking for gap fillers? You should be assembling a team as opposed to you yourself having, sole responsibility for knowing and accessing all these various subsidies and how to blend them together. Reach out to the various professionals that you're working with. Just ask them the questions in terms of ideas as to what they have, they have in terms of gap fillers. And that's also, is a demonstration of the importance of having a good financial model that's constantly being updated to best identify what that financing gap is. And I think you'll agree, Charlie, that the sooner you get the various parties together, the better. And I would say that CPA is pretty important because you early on want to have a financial model, try to get a sense as to what sort of financing gap you have and make sure that it's being accurately calculated. There's nothing worse than when we get brought in late and there are assumptions in the financial model that were inaccurate. It feels great when you advise the client on sources they missed. Not so good when there are sources that they overestimated.
Right. Yeah, no, and we get in earlier and earlier now. When I talked earlier about the bond cap being constrained, my clients are coming to me much earlier to help me to look at that, because at that point we're almost helping them to determine how much they need to ask for, right? And so instead of them having cloud do that and then come back to us later and say, "Oh, this is what we got," we get a little bit of a chance to get in on the front end.
Or when you mention, know what, your requirements are at the state level in terms of, being able to be successful at getting the bond allocation and or getting the tax credits. A developer wants to be mindful of what their financing is as they're negotiating with their approvals and all the rest, what type of property they're going to build, the density and all the rest. There are things that as you're negotiating to get your development rights that you might need to ask for to be successful with the financing. So at the end of the day, you ultimately can only build what the state agencies want to fund. So you need to make sure that you're building something that state agencies want to fund.
Right. That's right.
So thank you, Charlie. This has been a great podcast. I'll include your contact information in the show notes. I'm sure a number of viewers will want to be, and listeners will want to reach out to you directly to follow up on a number of the points. Please do stick around for the off mic section. But before we get to that, I would like to encourage our audience to subscribe to the podcast on your platform of choice. And please do share the podcast and our YouTube channel with your colleagues or anyone else that you interact with who you think would find these podcasts really useful in furtherance of their efforts on behalf of expanding affordable housing or in the other areas of community development that the podcast covers. So Charlie, now we're on our off mic section.
Yep.
And this is the part of the podcast where our frequent viewers and listeners know I invite guests to share a shout out to a colleague in the tax credit community. And it's a great way for us to recognize others in the communities where we work and the good work that they do. There's definitely not enough praise in this world and acknowledgement. Now, this is your first appearance on the podcast since we started doing these weekly shout outs.
Yes.
So I am particularly excited to hear who will be your shout out this week. Take it away.
So my shout out this week is Megan Altador, who's an attorney at Nixon Peabody. Megan and I have been working, we share clients. We've been working together for a very, very long time. She is tremendous at helping, especially on these bond transactions, right? Sort of fitting that we're talking about bond transactions, about working with the developers, working with the agencies, and working with all the parties involved, running these calls with 30, 40, 50 people on them and getting everybody moving towards a closing. She's a pleasure to work with. And more important than getting all that done, she's a skilled attorney. And so she's great. I love working with Megan. I look forward to when I hear that she's on the same deals that I'm in.
Great shout out. I'll echo your shout out to Megan Altador with Nixon Peabody. I've greatly enjoyed working with a variety of attorneys at Nixon Peabody, and Megan Altador is a great example of a great attorney at Nixon Peabody. To our listeners, thank you again. I'm Mike Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac and Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.